we're starting to see the bond market becoming the main focus here. And if you break the bond market, it stops all financing of everything. I think economic data is generally lagging. Also, it's one data point a month, right? We're used to markets that give us multiple data points every second, kind of thing. So one data point a month is pretty noisy. You don't look at what last hour's was in Bitcoin versus this hour and think, oh my God, this is the change of trends. You realize that it's noisy. So the forward-looking stuff suggests the economic picture's getting bad quickly, and usually unemployment follows. And we've seen it with the ADP and stuff like that. It's more frequent in data terms. So I think it comes down. I think what we're doing is we're in the final death throes of this. Oh my God, the Fed keep needing to go and go and go. Meanwhile, if I look at 2-year rates, they're at 4.3%. I think the one issue is something Mark touched on is the oil price does need to go down and stay down, because it is important, as Ran, you said, it's a big part of this. It's not all of the inflation picture. Housing, everything else is slowing down anyway, but oil does need to go down and stay down, and there's a fight going on. I think the fight will get won by demand. I think they will end up crushing demand, because European demand, if it doesn't get crushed via interest rate rises, it's going to get crushed by brownouts. I mean, in South Africa, Ran, what they do is they cut power. Yeah, the other thing is the break-even inflation rates have shot up again. They got low. The 2-year break-even got well below 2%, and then it just rocketed higher in the last couple of days. So, yeah, there's something in this inflation picture that's still unsettling. Whether it's the oil market or something else, I don't know, or it's the ongoing China situation, Europe situation. The Fed likes a strong dollar because it imports deflation. So you're buying goods at cheaper prices. So right now they're motivated for it. Other nations are not so impressed by it, but it's kind of okay, just about. For emerging markets, it's a real problem because there's not enough dollars around. There's a shortage of dollars. So it's a game of musical chairs. And Sri Lanka was the first one to fall on the floor as somebody ripped the chair away. And one by one, countries are falling by the wayside. So I think the thing is what's really interesting is people generally say the stock market needs to break. And I look at this and think, actually, the bond market's broken. It's decoupled from break-even inflation rates. It's decoupled from growth projections. It's decoupled from the business cycle in an unprecedented manner. So we've broken the government bond market, which is much more important. The equity market will do what it does, whether it goes to new lows and has another spike low or whatever. It's the bond market we should pay attention to. And what was the answer in the UK? Mark's T-shirt was the answer in the UK. Is they bought gilts. And I think Europe is next. I know Arthur Hayes just wrote a piece on this, and I wrote a piece on this, is Europe will be next, because if Italian spreads blow out, they'll be forced by their new mechanism to buy Italian bonds. So we're starting to see the bond market becoming the main focus here. And if you break the bond market, it stops all financing of everything. And that's why the Fed will stop. They've broken the big one, which is that. The dollar, yes, it could go further, and if it gets really unruly, then that'll be another issue, and Fed swap lines will come out. The ECB drew a small amount of Fed swap lines last month, but they will all come begging to the US for dollars, and that'll be the change of the liquidity cycle. But it is, I mean, Mark, a big thing about this is the pension system is the issue here. This is what people don't realize. We talk about these baby boomers. It's the pension system that's the issue. It's in the US as well. 60-40 obliterates pension returns. So CalPERS, CalSTRAs, everybody's underwater again. So what you've got is future liabilities exploding. And the only way of dealing with that is printing more money. I mean, I think last time I came to the show, I thought June was the low in ETH. And I still think that's the case. The thing I'm looking at is much like Joey is. I'm looking at like the Solana ETH cross. Solana's down 85% from the highs, right? It's got a lot of network activity, second only to ETH, really. And it bottomed. It bottomed in June. It retested in September in that cross. I kind of like all of this. I think the conditions are fully in place for both the macro to be turning over time and for these for the whole space to start doing well. And you'll see the risk-seeking behavior from something like Sol ETH. It's not a high-risk bet, so we're not talking about small tokens here. We're talking about, one of the next biggest ecosystems. If that starts outperforming, it tells us we've got some ability to take risk in the space. So I'm pretty comfortable here. So I'm think, if you've got capital, not many people have got any capital left, but if you've got capital to add, you can go behind the sofa and find some money. Just keep averaging in, because this kind of level of oversoldness, this kind of peak macro fear is what you want to be looking for. So look, earnings follow the business cycle. The business cycle is going lower. Question is what is priced in? There's a lot of people who do it from bottoms up, which what Urian's talking about is, okay, where are all the earning estimates? Do they need to come down? When I look at the year-on-year rate of change of the S&P 500 versus the ISM survey, it's already pricing the ISM at 42. So that's a deep recession already. Could it go a bit further? Yes. So the question is,
what the ISM is for those of you.
Institute Supply Manager Survey. It's basically like a monthly version of GDP. But when it gets below 47, it prices a recession. It's currently at about 50, which tells you growth is slowing down now. Once it crosses 47, it means we go to recession. And it's pricing in a reasonably deep recession. But the other thing is, I just wrote about this in Global Macro Investor. I went through almost every single investment survey that I could possibly find, from the Bank of America surveys for institutional investors through to the AAII surveys, institutional investment surveys, the whole lot. This is the most bearish everybody's been ever in the history of equity markets since all of these surveys began, essentially. So Mark's right, they're definitely going to come down. But the question is the impact as big as everybody fears, or is it already in the price? If everybody's record bearish, when you see Kotu and the massive tech hedge funds, 70% cash, you kind of know how bearish people are, because their job is to be invested in technology. So that's my caveat with that, is it kind of sets itself up potentially for a false break lower. The biggest fear is actually not that. The path of pain is not down, because everyone's prepared for it. Everyone's got the insurance. What the path of pain is if they don't go down. That's when they're all fucked. If technology went up in a straight line from here, Kotu are going to be forced to buy as the markets rise. I think the path of pain, looking at a 12-month, 6-month time horizon, the path of pain is high. And it's with cryptos the same. The crypto hedge funds are very gun shy still. Everybody's gun shy. And so if it goes high, there's a lot of institutions we've talked about many times on the show on the sidelines. Joey knows that too. I mean, everybody is interested. They've done the work. The moment the price goes up, everyone's short the upside. They're like being short calls. Everybody is.